You've got £2,000 sitting in your current account earning nothing. You know you should invest it. But every time you search how to start, you're hit with a wall of jargon about ISAs and ETFs and capital gains tax that makes your brain hurt. So you close the tab, tell yourself you'll figure it out later, and that £2,000 stays exactly where it is, slowly losing value to inflation, while you scroll through articles about millionaires who started investing at 23. Here's what nobody tells you. Starting to invest in the UK in 2026 is actually simpler than it's ever been. The confusing part isn't the mechanics of buying investments. It's understanding which account to use, why that matters more than you think, and how to avoid quietly handing thousands of pounds to HMRC over the next decade simply because you didn't know the rules. Hi, I'm Dex, and my channel is all about demystifying finance for the UK. So if you want personal finance content that actually applies to where you live, hit that subscribe button. Every video here is made for you. Let's start with the only account type that matters for most beginners. The Stocks and Shares ISA. This is your tax shield, and understanding it will save you more money than any investment strategy ever could. Here's how it works. You can put up to £20,000 per year into ISAs. That's your allowance for the current tax year, which runs from the 6th of April 2025 to the 5th of April 2026. Any interest, dividends, or profits you make inside that ISAs are completely tax-free forever. Why does this matter? Because outside an ISA, you're getting demolished by taxes you probably don't even realise exist. Let's say you invest £10,000 and it grows to £15,000. That's a £5,000 gain. Outside an ISA, anything above the £3,000 capital gains tax-free allowance gets taxed. Basic rate taxpayers pay 18%. Higher rate taxpayers pay 24%. You just lost hundreds of pounds because your money was in the wrong type of account. Dividends get hammered too. Outside an ISA, you only get £500 of dividend income tax-free each year. Above that, basic rate taxpayers pay 8.75% and higher rate taxpayers pay 33.75%. And be aware, those rates are set to rise again from April 2026 inside an ISA. You keep everything. And here's the twist most people miss. That £3,000 capital gains allowance used to be £12,300 back in 2022. The government slashed it. They're tightening the screws, which means ISAs have gone from a nice to have to absolutely essential. If you're not using one, you're volunteering to pay taxes you could completely avoid. Now, you might be thinking you'll just save in a cash ISA instead because investing feels risky. Understandable. But there's a problem brewing. Starting in April 2027, if you're under 65, the government is restricting new cash ISA contributions to £12,000 per year. The remaining £8,000 of your allowance will have to go into investment ISAs if you want to use it. The government is actively nudging you toward investing. So what actually goes inside a Stocks and Shares ISA? You can hold individual company shares, but for beginners, that's like learning to drive in a Formula One car. Instead, most people use funds. These are basically baskets of investments. A passive fund, also called an index fund, just follows a market index, like the FTSE 100, an index of the largest 100 UK companies. There's no fund manager, which means the fees are very low. We'll have another video on this coming shortly. But here's where it gets interesting. The platform you choose to open your ISA matters just as much as what you put inside it, because platform fees can silently eat tens of thousands of pounds over your lifetime. Some platforms like Trading 212 and Invest Engine charge zero platform fees and zero trading fees for ETFs. They are legitimate, well-established options. Now compare that to a traditional platform charging, say, 0.45% annually. Doesn't sound like much, does it? Let's run the numbers. If you invest £50,000 and it grows at 10% per year for 20 years on a zero-fee platform, you'd have roughly £336,000. On the platform charging 0.45%, that same investment would only grow to about £307,000. That's a difference of almost £29,000. Gone. Not because of bad investments, but because the platform quietly skimmed it off the top. If you're finding this breakdown useful, a quick reminder to subscribe would be a massive help. It lets me know I'm on the right track with making content that saves you money. Smaller portfolios get hit differently. Some platforms use flat fees. Interactive Investor, for example, has a core plan for £5.99 a month. That's nearly £72 a year. If your ISA only has £1,000 in it, you're paying an effective fee of 7.2%. That's brutal. But if you've got £50,000 invested, that same £72 is just 0.14% of your portfolio. Suddenly, flat fees look brilliant. The lesson is to match your platform to your portfolio size. Small amounts generally belong on zero-fee platforms, whilst larger amounts can benefit from being held on a platform allowing flat fees. What about ease of use? A platform could charge nothing and still be worthless if you can't figure out how to buy anything. Freetrade, which has over 1.6 million registered users, built its name on being dead simple. Trading 212 is similar. They assume you've never invested before and design their apps accordingly. Don't pay extra for advanced research tools you won't use as a beginner. Here's the step most people skip. Before putting a single pound into investments, you need to be brutally honest about your timeline. Can you leave this money untouched for at least 5 years? If the answer is no, you shouldn't be investing it. Markets go up and down. If you need that money in 2 years and the market drops 20%, you're forced to sell at a loss. But over 5 years or more, history shows markets tend to recover and grow. Opening an ISA takes about 5 minutes. You'll need your national insurance number and a debit card. The barrier isn't difficulty, it's decision paralysis. People overthink which platform, which fund, which exact moment to start. Meanwhile, their money sits there, losing value. If you're genuinely overwhelmed, managed ISAs exist. You answer some questions, and they build a portfolio for you. You'll pay slightly higher fees, but it removes the paralysis. The important thing is to start. One final point, the tax year ends on the 5th of April 2026. Any of your £20,000 ISA allowance you don't use by then vanishes. You can't roll it over. It's gone. That's not a sales tactic. It's just how the system works. So to recap, use your stocks and shares ISA to shield your money from tax. For small portfolios, pick a zero-fee platform like Trading 212 or Invest Engine. Choose a simple, low-cost global index fund and start. That £2,000 in your current account isn't going to invest itself. If this guide helped clear things up, make sure you're subscribed for more UK-focused finance videos. 5 years from now, you'll either wish you'd started today or be glad you did.